Right, guys. Good evening to all of you. After some time, reconnecting. So anyway, guys. So let's continue the lesson where we were discussing. Am I audible to everyone? Hmm?
Yes, sir. Yes.
Right. Okay. Fine. So let's discuss. I think at the end, let's discuss as to how we can cover up those two cover up classes. I know, certain guys are unable to have it on Tuesday. There's a bit of a concern. Institute said me. So in that context, if you guys are okay, let's figure it out. Maybe, to have the sessions maybe on a week end at your convenient. So let's discuss it at the end. Right. So let me share the screen. 1 minute. Right. We were talking about property. So sorry. If you look at, there are two types of funds we were talking about because 1 minute, I think we couldn't. Yeah. So if you look at the structure, so it can be a sort of a investment company, real estate investment company, and then that investment company may hold properties. So investors come and pool money into this investment company, and then you go ahead with investment. At the same time, the other structure would be that same real estate investment company may have different funds, right? So you come up with a fund, so say fund one, and then investors will pool the money for that, and then that fund probably take exposures into the different properties. One is a property one, or maybe a kind of a commercial property, and a property two, it may be a kind of a residential property, or maybe a property three, some kind of a warehousing property, whatever. So it's like that your fund will carry certain properties, and at the same time another fund can be launched, right? So then that fund will also be focused on maybe say industrial properties. So then you will carry different types of properties, different locations, etc. Under that. So likewise, you can come up with different funds under the investment company and hold properties. So then I'll touch base on this thing with the real estate investment trust. I think that's where the next few slides we are going to discuss that part. And if you look at these funds, maybe close-ended funds and the open-ended funds. If you look at the close-ended funds, basically fixed number of shares are issued, right? So we'll say when the fund is launched, that a particular fund will issue fixed number of shares. So then after issuing that, there won't be any new sort of a then and there issuance of the shares. So that the fixed number of shares. So then that will be issued by this investment company, right? And you can go to the market, or maybe through an initial public offering, you can ask the investors to invest in those new shares, right? So then the funds will be directed to the fund, or this particular close-ended fund. So shares are subsequently listed on the exchange, right? So then through the exchange that you can sell those shares, someone can buy these shares, right? So likewise, that will be exchanged through an exchange. So investors are able to purchase shares through a brokerage firm on the secondary market, like how you buy shares. So then you can buy the shares of these particular close-ended fund through the stockbrokers. You can buy and sell those things. So price reflect market price. There is a unit price or the share price there. So that price will be the market price of that particular fund. Now, say example, now we are talking about property, but you can see this close-ended fund for the certain unit trust as well, right? So then certain will say opportunities funds. You probably would have seen some of the listed opportunities funds. So then that's a close-ended fund, the fixed number of shares. So through the initial public offering that will be issued to the public, so public will invest it. So that fund will then invest in certain asset classes, maybe shares or whatever. Most frequently the shares, right? So in that context, those units or shares are listed through the exchange, so you can buy and sell through the exchange. So likewise, there is a market price for that particular fund. Whereas the open-ended funds, unlimited number of shares, that means at any point can issue further shares depending on the need. So we'll say you first issue shares, but again you need to issue shares maybe 2 months down the road or whatever time period, then you can still issue. So there's open-ended. So there's no limited number of shares. So those things actually you can't see it is traded because then and there that new shares are creating because it's open-ended, right? But if it is a close-ended, that definitely that will be listed and through the exchange you can do it. But for open-ended funds, it's very difficult to do that thing, and the open-ended funds are basically not listed. So in that context, yeah.
Do we have an example in our market, sir? Like for a close-ended fund? Earlier it was, I don't know now. Do we have any, sir?
Now, in a sense, earlier we had, I'm not talking about the property. There's no property related fund here. But if you look at this earlier, if you can remember, Candor Opportunities Fund.
Candor,
right?
yeah.
Candor Opportunities Fund was there. That's a close-ended fund, right?
Okay.
So that was trading, but I think now it has been liquidated, I think, if I'm not mistaken.
Yeah, they have already sold it. That's why I think.
Yeah, that's the thing. So earlier it was that was issued in 2015, if I'm not mistaken.
But now there isn't any sir, isn't it?
Yeah, but now actually I can't remember anything there. Maybe I'm not aware of that, but this is the latest thing that I can remember. Candor Opportunities Fund. Yeah.
Okay, another question, sir. Is this fund secured by the property that they purchase? Is it? How do they settle if they want to, the shareholders, if they want to close the fund?
Yeah, I think now say the Candor Opportunities Fund is not a property background. That's a kind of a investment in equities, right?
Yeah.
Equity. So then the share price, the market price reflect the underlying assets performances. That means equity portfolio performances. But if I'm not mistaken, at that time, at the point of the liquidation, the fund had not performed well, right? The equity, the investments were yielding, low yielding, and they have traded below the IPO price also, if I'm not mistaken, right? That's what I heard. So in that context, yes, there's no because all the if you sell the shares, everything, then you can realize at a lower amount, right? So then of course, the investors are getting the lower value. So there's no kind of a security as such in that context. Whatever the
property also no security, sir.
Same thing. If you will see the market prices are all, but the property maybe the other way around, right? If there is a capital appreciation and etc., so then there would be some gain underlying. But assuming if there is a capital loss over there, yes, that has to be borne by then the unit holders or the investors. Yeah. So traded at times which are detected by the traded at times which are detected by the fund managers. Prices for open-ended funds are fixed once a day at their net asset value and reflect the fund's performance. Now, here in the close-ended funds, there's a market price, market reflect, there's a market price there. Here, there's no market price, no, which is not traded, no, in that context, whatever the net asset value as at that day would reflect the fund's performances. Now, say, if you have taken, exposures in the property or maybe some equity, etc. So then you look at the daily net asset values. So then that will reflect the fund's performances. Only price at which can be purchased during the day. So then based on that price, actually you can purchase or maybe you can issue shares at any given point. No, there's no kind of a specific because this is open-ended. So then at any given point, if they want to issue shares and raise new capital, yes, you can do it. So then you will be issued at a that particular NAV or the price that you will issue the shares. So this is the open-ended funds. In property also, the same thing. So then you can issue shares, get new funding, and then you can go for another maybe investment into the properties, etc. That could be done. Yeah. And I just I'll give you a bit of a heads up on this kind of a real estate. Before that, we'll go ahead with these few things. Standard varieties of real estate funds, co-funds, low risk, low return funds aiming to produce a return benchmark against established property index. Yeah, but in Sri Lankan context, I don't know how these are worked, but what it says is there's a, say, property index is there. So we benchmark with that property index kind of a performances, and then you can have a fund to benchmark that, and that would be a kind of a low risk, low return, right? Anyway, so then that sort of a fund can be formed. That's called a co-fund, and co-plus value-added funds means uses higher gearing and more active management style to generate higher return. That means now, say, your fund will be further leveraged and rather gearing or rather through borrowings also, that you pump and you invest into the maybe new properties. So you are getting a bit of a high risk in that context. Why? Properties or other fund is also driven through the kind of a borrowings. So in that context, you expect a higher return because you have to give a return to your lenders as well. So in that context, you try to, then and there try to realize your gains and sell properties again, buy at a, low. So likewise, there are, more active management. So you actively, not a buy and hold kind of a thing, you actively manage these properties and try to get more gains, because you need to generate those higher gains because you have borrowed funds also. Then you have to pay back all these things also. So then that's a bit of aggressive kind of a strategy. So then the co-plus, that's called co-plus and value-added funds, right? In a co-fund, it's a bit of a very conservative. You invest in and you expect the, over the period of time, you come up with the capital gain. Maybe you hold on to few more years, etc. So then in that context, your risk is low, and at the same time, your return may also low. But opportunistic fund, typically close-ended. That's what we were discussing earlier, right? Opportunities fund, those are predominantly close-ended funds, aim to exploit opportunities to acquire property from distressed sellers, right? Some of the distressed sellers, because if you look at some of the, we call it distressed assets, some of the kind of a high geared, whatever thing, they try to now sell at a very low price and realize the money and pay off their debts and etc. because that's where the distressed is. So then you can get the property at a very distressed number or this distressed valuation, and you redevelop. And in emerging markets, they are similar in nature to private equity funds. Yeah, in the private equity funds, all the same thing. No, so you try to buy the company at a very low valuation, right? Company at a low valuation, and then you develop the company into a different phase. And after 5-10 years, then you sell the company and end up with, realize your capital gain at a few folds. So same thing. So you try to acquire properties at a distressed valuation, distressed price from the distressed sellers. So then you redevelop, and then you develop the property into a new level, and then you sell the property at a very thumping valuation, very higher price, and get a fantastic capital gain. So that's sort of opportunistic fund. So there are three standard varieties of real estate funds. One is co-fund, it's a low risk, low return fund, and then you basically benchmark it against with a property index. And a co-plus value-added funds, that's a bit of aggressive. You drive through the gearing or more borrowing also, and due to that, you need to actively manage, aggressively manage this thing. So you probably end up with higher returns since you are more aggressive in nature. And opportunistic fund, basically, it's a typically close-ended fund again, right? And then you try to buy properties at a very distressed valuation from distressed sellers and try to redevelop and try to create more value. And then after some time, you try to sell at a high valuation and get a good sort of a return. And let me take you through the real estate investment trust. Let me share a kind of a slide again that will give you a more better understanding. Give me a minute. Right. If you look at, what is REIT? REIT means Real Estate Investment Trust. Is a company that owns or operates income-producing properties. Basically, that particular company, or that we can call it as a fund, that will hold income-producing properties. Because at the end of the day, the investors are putting money. So get a gain, right? Get a consistent dividend or maybe a capital gain. So in that context, you have to invest in a properties where that yield income. So income generating properties. So collective investment device for real estate model after mutual funds, highly liquid investment due to listing in public markets. Yeah, basically these real estate investment trust REITs are listed in a public market or stock exchange, right? So now, if you look at 2020, Securities and Exchange Commission, SEC, introduced this REIT structure, right? They came up with the entire regulatory framework to initiate or structure REITs in Sri Lanka as well. The regulatory mechanism was published, but so far no REIT has been introduced. That's due to there are several loopholes in that particular regulatory mechanism. So until those are cleared, you can't see any sort of a REITs in Sri Lankan context. But technically, you can form a REIT and list in the stock exchange. That is possible under the laws in Sri Lanka right now. So then 90% of distributable income repaid as dividends, generating a steady income stream. Yes, now the law in globally and even in Sri Lankan laws would be whatever the particular distributable income that you generate from this particular REIT, 90% need to be paid out as dividend for the investors who put the money to this particular REIT, right? So that's where you can come up with a more steady income source as dividends for the investors. So this is sort of a mechanism as to how this REIT can be workable. So you can see real estate investment trust is there, right? And which is managed by a fund manager that's called the REIT manager, right? So REIT manager will manage the real estate investment trust, right? So trust is funded by public unit holders, right? Public unit holders. So basically, when the REIT is formed, the REIT has to be issued, or rather, REIT need to issue shares in the stock market through an IPO. So then the public investors invest money into this REIT, right? So in turn, they will be getting shares or units, whatever. Then so they invest money. So the real estate investment trust will get those money in the IPO from the shareholders. So then they have IPO funds and they have the sponsors. Sponsors maybe particular asset also, right? What do you mean by the sponsor? Sponsor is the party who need to first transfer the asset to form this REIT, right? So an example, you have the property, you first transfer the asset to the real estate investment trust, and then you'll become basically the majority or other major holder of the asset, right? So then out of the real estate investment trust total shares, bulk is maybe say 60%, 70% maybe owned by you. So then for the equivalent of 30% or whatever that number of shares, then that stake that you will be issuing new shares to the public. So public will invest it. So the public public may own 30% and 70% owned by you, right? So likewise, your real estate investment trust can be formed. And then out of those new funds that you raise again, further that you can, invest in further new properties, etc. So then the properties will give you kind of a rental income, right? So that will be the income of the real estate investment trust, right? So end of the day, these assets, so the properties are owned by whom? Real estate investment trust, right? And there is a trustee is appointed to supervise the REIT. So then for that, you have to pay a trustee fee for the trustee, because trustee is there to encourage or rather protect the interest of public shareholders, public unit holders, we call it as. So then the operations, everything will be scrutinized by the trustee, right? The REIT manager will make the decisions on what properties to be invested and at which point the properties are going to be sold out. So likewise, he will make the decision. So then recurrent income for the REIT would be the rental income that you generate from the property. Now, assuming this is a commercial condominium property, real estate is, REIT is a condominium REIT. So then if it is if you own the all healthcare assets or other hospital assets, that would be the hospital REIT, right? And if you own all hotel properties, then it can be a hotel REIT. So likewise, there may be different REITs, right? So it's a warehousing REIT, because you own all the warehousing properties. So then it's called a warehousing REIT. So likewise, different form of different class of properties you can hold it. So then your REIT will be changed accordingly. So that will be managed by the REIT manager, like a fund manager who manage the equity fund or a debt fund. Likewise, the same thing. So that's how the things goes on. And property will generate rental income. That's the recurrent income for the REITs. And probably we'll say annual basis, if you make profit, distributable profit, then 90% has to be paid off to the unit holders. So whenever the asset is property is sold and get a capital gain, yes, then that's for the REIT, that capital gain comes to REIT, and the REIT can declare a dividend for the public unit holders. So that's how it goes. This is sort of a real estate or other REIT, real estate investment trust. In Sri Lanka, there are certain areas where the legally or rather this particular regulatory mechanism may not really helpful or friendly to form a sort of a REIT structure again, because there are certain tax areas a bit of a bleak right now, because the last budget I can remember some stamp duty waived off and some capital gain tax basically relaxed, etc. But I think there are certain areas need to be revisited and worked out further for us to see a proper REIT also to come in place. There are a lot of regulatory lapses. There are still there are gaps to be filled. So in that context, yes, but legally that is now allowable in Sri Lankan context. All laws are available, but only thing is no REIT being listed yet.
The questions are, what is the return to the sponsor? Is it that 10% out of the income? Or?
No, now say sponsor in a sense. Now say if I have a property,
yeah.
Now, what my intention is to transfer my property or REIT, and then realize because I would have now one option is I'll be able to sell the property, right? Sell the property, and then I'm going out from that. But what my intention is, I'll transfer my asset into the REIT, and on top of that, I can gain. I can realize part of that money. Say 30% will be issued to the public, and public will pay to the REIT, and then that money comes to the sponsor. right? So in a sponsor's point of view, that you transfer the asset to the REIT while realizing part of the money and keeping some part of the money, part of the property for you to realize in down the road with the capital gains, right? So then it's like this again, that again another thing, because sponsor, if you sell it upfront, then you get the entire cash flow. No? But here in Sri Lanka, what the law says is that sponsor need to hold on to the asset. You can't sell the you have to transfer the entire asset, but you can't realize the entire money. So then that is a one major area where sponsors are getting discouraged, because then obviously then the sponsor has a chance to sell it upfront. But others, I think other markets where you can fully transfer the to the real estate investment trust and realize it, and you can get rid of. But here that you can't get rid of. That's one area where these REIT structures are having obstacles, because sponsors are looking at it as a obstacle. It's no point of holding part of the not the ownership, because you transfer to the real estate investment trust, so you don't have the ownership, but still you hold on to the shares of the REIT in turn, and you can realize a part of it. So sponsors point of view, the whole idea is, yes, you can transfer it to the REIT and realize part of it, and you can keep the part of it in the form of shares, not the form of property. But later on, you can get the capital gain and the other rental advantages, and you can have a sort of a constant cash flow in while realizing part of the money, right? But in other markets, what happens is sponsor can form a REITs, and he can transfer the entire asset and fully goes out, right? So that's
So the sponsor will hold 80% of the shares, we say. Can he hold it like that? And
yes,
20%?
exactly. Not the
So
property.
then he will get then he will get the dividends from
Exactly.
the
You'll get the dividend.
Okay,
Yes.
okay, right.
He'll get the
Okay.
dividend because he owned the shares of that. So
Right.
for that, he will get the dividend. Dividend are paid by the REITs from the income that you generate. What are the income? Basically your rental income and maybe the capital gains, right? So that's how the mechanism is. Right? Just for your understanding, and moving again.
Excuse me, sir. Sir,
Yeah,
when
go
it
ahead.
comes to stocks, like we see something like equity funds, like some institutions do that. Like just like mutual funds, there are equity funds like this. This is also kind of real estate fund. So how those equity funds work actually?
You're asking again. Please go ahead. Go ahead. The question again.
Sir, like when it comes to like real estate, there are funds like REITs, right? But I heard in stock exchanges, like stocks, there are something called equity funds, right?
Not
So
stock exchange. Basically, equity funds are in with the unit trust or maybe the mutual
oh,
funds, right?
yeah, like that, yeah.
Yeah. Okay. Then your question is,
Like how those equity funds work actually?
yeah, no, it's like this now. Say if you look at a mutual fund or a unit trust. Now, I think we discussed about the money market funds. What money market funds? How does it work? You as investors, you pool money, you invest money into the fund, and the fund will pool money, and they will go ahead with some short term say 1 month to 1 year period money market or fixed income securities, right? Those are their investments, and out of that, whatever the income that generate interest income, and that will be the return for the money market unit holders or the investors. The same thing, that equity fund can be formed. So that fund can be focusing solely on the IPOs. That's another fund. Another fund can be focusing on the, say, hotel sector equities. There's another fund.